All right, let's jump right into this because something pretty historic just went down in the silver market. While all the Western markets were closed, the price for actual physical silver in retail shops all across China shot up to $91 an ounce. And just to be clear, this isn't some forecast or a prediction. This was the real price for real metal changing hands.
And that brings us to this number, $11.41. So what is that? Well, that is the huge, undeniable gap between the price people are paying for physical silver in Shanghai and the paper price for silver being quoted on the COMEX exchange over in New York. You just don't see dislocations like this very often.
And here, you can see that conflict laid out plain as day. On one side, you've got Shanghai at 91 bucks. That's the price for tangible metal you can hold in your hand. And on the other, you have the COMEX at just under $80. That's a price for a financial contract on the screen. Now, whenever you see two prices for the exact same thing diverge this dramatically, you can bet the resolution is not going to be quiet.
So, we really need to dig in and understand what this is signaling about the market as a whole, because this is so much more than just your typical markup you'd pay for a silver coin. This is really about which market is telling the truth. Now, I know the first thing skeptics are going to say. They'll say, oh, that's just retail prices, they always have a premium. And you know what? They're right, they do. But even when you account for all the normal costs, fabrication, shipping, all that, when physical metal is selling for this much more than the paper price, it's telling you something is fundamentally different this time. It's telling you that the market might be shifting towards something called physical price leadership. And that's just a fancy way of saying the price for getting metal in your hand right now is starting to become the real price, and it's undermining the authority of that price you see on the screen.
And that forces every single person in this market to ask a really basic question. Which price is real? The one where you can actually get the metal, or the one that just exists as pixels on a screen? The answer to that is getting a lot clearer. Okay, so this all sets the stage for a massive showdown when Western markets open back up. I mean, a price gap this big can't just sit there forever. It has to resolve, and it's probably going to happen in one of two very violent ways. So, scenario number one is that the paper price is forced to surrender to the physical reality. You can see COMEX gap open way higher, say $83, maybe $85. That would instantly crush anyone who bet against silver, forcing them to buy back their positions. And that buying triggers other people's safety nets, their stop-loss orders, which then triggers the trading algorithms, and suddenly you get a price cascade that moves like an elevator, not the stairs.
Then there's scenario two, which is a full-on counterattack. The big players could try to crush this story by dumping a massive number of futures contracts right at the open, slamming the screen price down to $77, maybe $75. And make no mistake, this isn't about reflecting supply and demand. This is pure psychological warfare, designed to make everyone doubt the physical market and restore faith in the paper price. But there's a huge flaw in that strategy. It only works if the physical market gets scared and follows it down. Think about it. If they push COMEX down to $75, but dealers in China are still demanding $91, that gap just blew out from $11 to $16. That would be a complete disaster for them, proving that the physical market is the one in charge now.
So that begs the question, right? What is giving the physical market all this strength? To really get that, we need to look at some of the structural forces that are working under the surface. First, let's just get a sense of scale. On any given day, the paper market, the COMEX exchange, can have contracts out there representing over 900 million ounces of silver. It's a staggering number. But now, compare that to the reality. The amount of actual physical silver sitting in the COMEX vaults that's registered and available for delivery is often less than 70 million ounces. You can see the problem right away, this huge imbalance between paper promises and physical reality.
And this imbalance has a name. It's called the leverage ratio. It's simply the ratio of how many paper claims exist for every single ounce of physical metal that's actually available to be delivered.
So, to put it simply, for every single physical ounce of silver sitting in the vault, there can be as many as 13 different paper claims all pointing to it. The entire system is built on an incredible amount of leverage. And look, a system like this works perfectly fine, as long as almost nobody ever asks for the real metal. But it becomes incredibly fragile the moment a significant number of people decide they actually want to take delivery, because that's when the physical shortage is exposed for everyone to see.
And we have to remember, this demand for physical isn't just investors buying coins. It's being driven by massive, and I mean non-negotiable industrial needs. New solar panels are actually using more silver, not less.
The next generation of EVs could use up to a full kilogram per car. The AI boom means we're building data centers like crazy. All of these things absolutely require huge amounts of physical silver. And for these huge industrial buyers, demand is what economists call inelastic. A company making solar panels can't just shut down their factory because the price of silver went up. They have orders to fill. For them, getting their hands on the supply is way more important than what they have to pay for it. They have to buy.
Okay, so that's the setup, that's the battlefield. Now let's get practical and talk about the specific signals you need to be watching for when the market opens. These will tell you exactly which scenario is winning out.
Here's your 5-point checklist. First, just watch the price. Is COMEX moving higher and staying there, or does it spike and then fail? Second, keep an eye on those physical premiums. Are dealers in Asia still holding that high price? Third, what's the gap doing? Is it closing because paper is rising or because physical is falling? Fourth, look for any news about inventory stress, things like shipping delays or dealers rationing sales. And finally, number 5, just observe the character of the volatility. Is it a calm, steady move up, or is it just chaos?
And here's probably the most important takeaway. If we see them try to smash the price, that's scenario B, and it fails, if the price refuses to stay down, that is the single most bullish signal you could ask for. It would be absolute proof that the physical demand is real and that any attempt to suppress the price with paper is only going to be temporary.
Now, all this has very different meanings depending on how you're positioned. If you actually own the physical metal, the long-term fundamentals look incredibly strong. But if you're trading with leverage, you have to be so careful. This kind of insane volatility can wipe you out in an instant, even if you're right about where the price is headed in the long run.
And all of this brings us right back to that final, huge question that the market is now being forced to answer. Which market is the real one? You know, for decades, the easy answer was always the paper market. But that $91 price tag from Shanghai is screaming that the power might be shifting, and the answer, well, it's just not that simple anymore.